If you're over 60 and you keep money in a bank, a policy quietly approved by 7 federal agencies in December 2024 could affect your ability to withdraw your own funds without warning when a teller decides something looks off. Almost nobody has heard it at all, and when most people finally learn it's real, they're usually already in a manager's office, answering questions they never expected to face without any warning. Today, we'll go step by step through what's new, correct some risky rumors circulating online, and lay out a practical checklist you can use this week, so your savings remain in your hands, not stuck behind a bank counter for long. Let me begin with an example that shows exactly why this topic matters so much. I'll call the woman Margaret for now. Margaret is not a single individual. She's a combination of true cases, put together so you can recognize the full pattern unfolding in banks today. Last spring, a powerful storm hit her area and wrecked her roof. A contractor appeared a few days afterward, looked things over, and said he'd fix it for $18,000 in cash right there, up front. Margaret had that amount. She'd been putting aside for years. She went to her bank to withdraw it, and the teller immediately called the branch manager. The manager brought Margaret into a private room and began questioning her there. Who was this contractor? How did she meet him? Had he come to her home before? Did he ask for cash specifically? Then the manager explained that under bank policy, they would place a hold on her withdrawal for 15 days while they checked whether anything improper was going on here. Margaret was livid. She kept repeating, "This is my money. I earned it. I need it." And she was absolutely right about that. But here is where the story turns. About a year earlier, when Margaret opened a new CD at the same bank, an employee asked whether she wanted to list a trusted contact on the account as well. She wrote down her son's name and his phone number. It took 5 minutes. During the 15-day hold, the bank called her son. He asked a couple of questions, and within 20 minutes it was obvious the contractor had raised the price 3 times, had no license anyone could confirm, and told Margaret he only wanted cash because the IRS was chasing him. It was a scam. Her roof wasn't damaged the way he said it was. Margaret would have given $18,000 to someone she would never see again ever. The hold stopped it. Her son stopped it. She still had everything. But now imagine the opposite outcome for her. The version where the contractor was totally legitimate, where Margaret truly needed to pay for real repairs on her roof, and the bank froze her withdrawal for 15 days, with no trusted contact listed to untangle it and speed things along. That situation is happening to older Americans in banks every day. The gap between those outcomes is one form, one person's name, and one number today. Hold on to that, because we'll return to it very soon in detail. To see why Margaret's bank could do that, you have to know about an older rule that has quietly lived in federal law for more than 5 decades at this point. Back in 1970, Congress passed the Bank Secrecy Act, creating a requirement that any cash transaction above $10,000 in one day triggers a currency transaction report automatically, every time. The bank submits it. It is sent to the Financial Crimes Enforcement Network, called FinCEN, a bureau inside the Treasury Department for review. It does not get sent to IRS. This report is automatic. Banks submit millions of these each year. By itself, the report means nothing and does not prove any wrongdoing took place here. Trouble starts with something known as structuring. If you intentionally split a deposit or a withdrawal into smaller chunks to avoid tripping the $10,000 report line, that is a federal offense, even when every dollar came from legal work and clean savings accounts. The key point about this rule is that the $10,000 amount has never moved even once. Ever. It has not changed since rules set it in 1972. The Government Accountability Office issued Report GAO 25106-500, explaining that if the threshold had been adjusted for inflation the way Social Security is indexed, the number would sit near $73,000 today instead now. In 1970, $10,000 was more than many Americans earned in an entire year. It could have purchased 2 brand new Cadillacs then. Gas cost 36 cents a gallon. A home cost $23,000. That law was aimed at drug traffickers hauling suitcases filled with cash. In 2026, it can snag a retired teacher paying a roofer. That rule is outdated. The world surrounding it has changed almost beyond recognition. And that gap is why things keep getting harder for retirees when they stand at the teller. Now I want to show you three quiet shifts, because each one changes how banks deal with you and your funds in real time starting right now. The first shift is what happened to Margaret. In December 2024, seven agencies, the FDIC, Federal Reserve, Consumer Financial Protection Bureau, Office of the Comptroller of the Currency, National Credit Union Administration, FinAncin, plus state regulators, released a joint interagency statement about elder financial exploitation and what banks should do when they suspect it happening. It encouraged banks to place temporary holds on transactions when they believe an older customer may be getting financially exploited right now. Depending on the state you live in, that hold can last 15 days, 45 business days, or longer. Florida law permits holds up to 45 business days there. Georgia recently passed a law giving banks similar authority too. Other states set their own separate rules. The motivation for this is real and alarming. FinAncin data shows more than $27 billion in suspicious activity linked to elder exploitation moved through banks in the single year ending June 2023 across the entire country. These holds are meant to stop scammers from emptying senior accounts before anyone steps in. That is the protective goal. But in practice, your bank now has wide permission to delay a withdrawal if something triggers their internal red flags, and you could wait days or weeks to access your own money, unless you already have the right paperwork and contacts ready before you ever walk in. The second shift involves apps such as Venmo, PayPal, and Cash App. After my last video about the $10,000 rule, many viewers told me they stopped sending money to relatives through these apps because they thought the IRS now tracks every payment above $600 and would tax it as income. That is incorrect. And I don't want you to stop supporting your family because of a confusing post that went viral online on social media. Here is what really occurred. For years, there was a proposal to cut the reporting threshold for third-party payment platforms from $20,000 to $600 per year. That proposal kept getting postponed. Then in 2025, Congress passed the One Big Beautiful Bill Act, signed July 4, 2025, which permanently reversed that $600 threshold for good, no exceptions. For 2025 and every year after, Venmo, PayPal, and Cash App must send a 1099-K to the IRS only when you receive over $20,000 in more than 200 transactions in one calendar year, and only for payments marked as business transactions, not personal ones between family members or friends. Personal transfers between friends and relatives are not treated as taxable income. If you send your granddaughter $300 for her birthday, it does not appear on any IRS list. If your son sends you $5,000 on Venmo to cover a medical bill and labels it a personal payment, it is not on any IRS list either as taxable income. And Zelle is different from those apps because it moves money directly between banks. It is not considered a third-party settlement organization under IRS rules today. So it never sends any 1099-K forms at all. Keep supporting your family. That $600 rule never became active. The third shift is less about legislation and more about banking technology itself. The software banks use to detect patterns and flag transactions has become far more advanced recently. Let me use Terry Deco's story to show why this matters here. Terry owned a small grocery in Fraser, Michigan, and operated it for 30 years straight. He was in his 70s. In 2013, the IRS seized about $35,000 from his business account, not because he broke any law, but because his deposit pattern resembled structuring to a computer system they used. Terry carried an insurance policy that capped cash coverage at $10,000. So he deposited amounts that stayed below it. An algorithm noticed the pattern. The government seized his funds. It required 2 years of legal effort and a public interest firm, the Institute for Justice, to recover it and clear his name. Terry's case was not unique either. In 2017, the Treasury Inspector General for Tax Administration reviewed 278 IRS structuring seizures and found that in 91% of cases where the money's source could be identified, it had been earned legally by ordinary people running honest businesses. These were not criminals. They were shopkeepers, dairy farmers, small business owners, and retirees whose deposits happen to match a pattern on a screen somewhere. By 2026, detection tools are much more powerful than they were when Terry's account was taken then. They catch smaller signals. They cross-check activity across branches. The law still says $10,000, but Banks' internal monitoring watches patterns far below that amount and treats them as worth attention in many cases today. So the old tip people shared, keep deposits under $10,000 to stay unnoticed, is exactly the approach that can get your account flagged in 2026 by the bank's own software. Do not split a transaction just to stay under it. That is structuring, and it is a federal crime even when your money is completely legitimate. Now, I want to correct 3 online rumors because any one of them could push you into doing the exact wrong thing with your account at the bank. Myth 1 says the reporting level dropped from $10,000 to $7,000. That is untrue. The legal trigger for a currency transaction report remains $10,000, and it has not changed since 1972. Banks may monitor smaller amounts using internal tools, but the law's required reporting threshold has not shifted at all. Myth 2 is one of the most harmful ones I've seen yet. Some videos claim a retired couple got a letter from their bank saying a suspicious activity report was filed on their account and they were notified. That account of events cannot be accurate because federal law makes it a crime for a bank employee to tell a customer that a suspicious activity report exists on their file. That rule is in Title 31 of the U.S. Code, Section 5318, and regulators like FINRA reinforce it for every bank. Any employee who tells you a SAR was filed is personally violating the law right there. What you may receive instead is something else entirely. You might get a source of funds letter, a compliance request asking you to show where the money came from. You respond with your documents and the issue is usually settled. That is completely different from a SAR notice, which cannot legally be sent ever. Myth 3 says that once you turn 65, the government watches your accounts more than everyone else's as surveillance and targets seniors for extra scrutiny alone. That is not what this is. The December 2024 Elder Protection Guidance from those 7 agencies is meant to protect seniors from scammers, not to spy on them at all. The added focus on older accounts is intended to keep predators away from those balances. And if you use the form I'm about to mention, you control that safety net, not the bank, and you decide who gets called. Which brings me to the most important action step from everything we've covered so far today. Go into your bank this week and request the Trusted Contact Designation form there. Do not ask for something called a Senior Safe Banking Authorization. That phrase has been circulating online, but it is not a real product offered at any major United States bank today. Someone simply invented that. The real name is Trusted Contact Designation. Every major bank has it available, and it costs nothing too. You complete it a time. You list the name and phone number of one trusted person, usually an adult child, a brother or sister, or a longtime friend. That person does not receive access to your money. They cannot sign documents. They cannot view your balance. What they can do is pick up the phone when the bank calls with concerns, and that one call can turn a 15-day freeze into a 20-minute clarification with everyone satisfied. FINRA, the SEC, and the North American Securities Administrators Association have supported this approach as a way for people to stay in charge of their own protection, financially speaking. Here is a 4-step plan that connects everything we discussed. Step 1. State purpose at the counter. When you withdraw a large amount of cash, calmly tell the teller what the money is for today. Step 2. Never split deposits or withdrawals. Do not divide a transaction into smaller parts to stay under any limit. That is structuring, and it is a federal offense. Step 3. Submit documents the same day. If your bank sends a source of funds letter or any other compliance request, answer immediately with your paperwork attached. Step 4. Choose a contact for every account you have. That one form is your strongest protection against scammers and against unnecessary access delays later on. One more item to remember. In October 2025, Senators John Kennedy and Tim Scott introduced legislation called the Streamline Act in Congress. If it becomes law, it would raise the $10,000 currency transaction report threshold to $30,000 and require Treasury to adjust it for inflation every 5 years from then on. As of April 2026, it has bipartisan interest in the Senate Banking Committee, but it still has not passed and is awaiting votes. The discussion in Washington is moving, but we are not there yet. A rule written in 1970 may finally be updated to match the world we actually live in today. If that happens, I will cover it immediately. You worked your life to earn this money. You supported your family with it. You saved for decades, even when saving felt impossible. You should not need an attorney to access your own funds. You should not feel scared of your own bank. You need to understand what almost nobody is explaining to people over 60 right now. And now you understand.